The U.S. stock market closed in light green today. But behind the calm were many important signals that investors need to understand so as not to miss out on major market movements. The S&P 500, Nasdaq, and Dow Jones all increased, but increased by a small margin, which does not show excitement, but reflects a particularly cautious, optimistic mentality. Money did not withdraw from the market, but did not rush in either. Analysts call this a period of controlled expectations. The decisive factor in today's session was PCE, inflation data, the measure that the Fed prioritizes when adjusting policy. The newly released figures show that inflation cooled more strongly than expected. This is a golden signal because it opens up the possibility that the Fed may cut interest rates in the near future, only when inflation goes down. Can the market expect a financial environment where there is room, and only then will important sectors have a chance to bounce back? The evidence is that the technology group has responded immediately to large cap stocks, especially those with strategies related to AI or growth ecosystems attracting cash flow. The important thing this year is that investors are choosing very carefully, no longer investing in growth companies with stories, but focusing on businesses with real profits, healthy financial reports, and clear long-term potential. Another positive factor supporting the market today is the stronger-than-expected increase in U.S. consumer confidence. When people believe that their financial situation is stable, they will spend more. Personal spending in the U.S. accounts for nearly 70% of GDP, so even a small change in consumer sentiment can have a big impact on the economy. When confidence increases, the e-commerce, entertainment, retail, tourism, services, and consumer technology industries all benefit. This shows that today's market increase is not due to a single factor, but thanks to the resilience of macro and consumer sentiment. However, the market today also revealed slight fluctuations that many people did not notice. These are silent warning signals. Oil prices are showing signs of rising again, and if this increase continues, it could cause inflation to reverse. As energy costs escalate, the Fed will be forced to keep interest rates high for longer, and that will put pressure on the market. In addition, the employment data released this week could also create big fluctuations. If the labor market is too strong, the Fed will worry about inflation. If it is too weak, investors will worry about recession. Therefore, any unexpected data can cause U.S. stocks to shake strongly. In addition, geopolitical risks always exist, can appear at any time, and have an immediate impact on prices, metals, energy, and financial markets. Today's money flow reveals a very remarkable thing. It is becoming more selective than ever. The technology group leads, but not all. Only businesses with a really strong foundation attract money. The consumer and service groups benefit from improved public sentiment. The energy group is still closely observed, but not prioritized due to the risk of oil price fluctuations. The industrial group is also being watched, because if the U.S. economy continues to grow, this will be the group that has the potential to explode in the coming quarters. So what should investors do? First, don't follow FOMO. The market is in a transitional phase and not always increases with a stable mood. This is a good time to observe, not to rush in recklessly. Second, focus on industries that directly benefit from expectations of lower interest rates, such as technology, retail, entertainment, and e-commerce. Businesses with positive cash flow and a clear eye strategy are where the big money is flowing. Third, portfolio diversification is still the wisest strategy. Don't put all your capital in a single industry group. Balance your bets between growth, value, energy, and defensive ETFs. Finally, keep a close eye on the macro data. Inflation reports, jobs, the FOMC, and earnings season will dictate the direction of the market in the coming weeks. In the big picture, the U.S. market faces three scenarios today. 1 is continued growth if inflation cools steadily. 2 is consolidation if economic data is mixed. And 3 is a short-term correction if there is an oil shock or 2 negative jobs data. But most importantly, the long-term trend remains positive. The market is showing a return to confidence, albeit cautiously. This is not a time for panic, but for sobriety. The smart investor is not someone who is rushing into the future, but someone who understands what the market wants. When you see the money, you avoid emotions. When you understand the big picture, you don't get swayed by short-term news. Today's session once again reiterates that the market may fluctuate day by day, but the big cycle always operates. According to its logic, inflation falls. Interest rates fall, consumption remains. Businesses thrive and cash flows return. That is the foundation the market is building. And that is also the reason why the current direction can open up.